What's up, Wildcatters? Welcome back to another episode and a first ever cross promo. We're doing two shows in one. This is an oil and gas startups meets Chuck Yates needs a job.
It was really funny. I had a buddy that was in a band and coming out of college named Toy Subs. And about 3 years later, they changed their name to something else. And I asked Jamie, the lead singer, I go, what happened? He goes, we've evolved as artists. We've become so much better and all that. Talked to the drummer. He went, yeah, we went to every record company as Toy Subs and they told us fuck off. So we had to change names. So that may be what we're doing today on the cross strategic promotion. But welcome to Chuck Yates Needs a Job, the podcast as well.
We've got Chris Atherton here, CEO of EnergyNet. Everybody knows you guys. Everybody uses you guys.
Hey, thanks for having me today.
But does anybody know this? Does anybody know the story?
I don't know.
That's what we're here to find out.
Yeah, certainly.
Who is Chris Atherton and what is the actual story behind EnergyNet? You guys have seen some shit. You've been doing this for 20 years now, right?
Yeah, definitely. No, it's been a wild ride. So I was actually Chuck and I had lunch earlier this week, and I was telling him next month in October 2022 I will be personally at 20 years at EnergyNet, which has been a pretty wild ride. Seen a lot. Seen shale booms and busts and all kinds of companies come and go and people come and go. So my background a little bit, grew up in Houston, grew up down in Clear Lake, went to Clear Lake High School. And then I worked at Enron out of college. That career path didn't work out for me, blew up a little bit. And then
which group at Enron?
Enron Energy Services. So I was in Lou Pye's group.
Yeah, Lou Pye's group.
Oh, yeah. Wow.
He likes the gasoline on his clothing. So I worked there. That blew up. I joined EnergyNet in October of 2002 as a business development manager here. Bill Britton started EnergyNet really as a way to create liquidity in the oil and gas asset market.
What's Bill's background?
He is a West Point grad, born and raised in Amarillo, Texas. Officer in the Army. Then he worked for a large ranching family, an oil and gas family out in the Texas Panhandle. And then started an E&P company with his partner, Jim J. Brewer, called J-Brex. And they operated in the Mocaine-Laverne area of Oklahoma, Texas Panhandle. Probably at their peak, maybe operated 300 wells or so. But they were real active in the A&D markets at that time. So he, is kind of the advent internet 1.0. Yahoo.com and all that. So he decided to start EnergyNet to create this liquidity for oil and gas assets instead of maybe just kind of for sale by owner type things. And even at that time, energy investment banks were relatively a new thing. I mean, Randall and Dewey were we're a two-guy. We're a 5-man shop at the time. But really, so I started in a couple years after the company started. When I started, I think we sold $25 million in assets around that time. Now we've sold about $9 billion in assets.
Was it always internet based when it started?
Always.
Okay, because and technically I am Gen X. I am not a boomer, but you're absolutely right. Randall and Dewey had started up. You kind of had the small shops actually doing property sales. You also had Oil and Gas Clearinghouse doing the let's rent a ballroom at the Holiday Inn and let's sell properties in a live auction. And they were, I think, transitioning online probably back at that point.
Yeah, and I mean, Oil and Gas Clearinghouse still exists today, but back then, I mean, part of our really kind of DNA and story is that we were getting our asses kicked and head kicked in by kind of the 800-pound gorilla in the room. They'd been in business, 7-8 years ahead of us. We're holding these, auctions at the hotel ballroom. No internet at that time, but it was there was $50 million sold in an auction, and they held one every month. And every time their brochure came out, it was like a kick in the gut to me. Like, oh man,
did they pioneer that, or they just became the best at that kind of format?
Well, all right. So a brief history of time. So back in, this is 86, the oil bust happens, a financial crisis really, but there was also savings and loans, thrifts. So like 600 to 700 banks, savings and loan banks failed. And similar to 2008, when they created TARP, the U.S. federal government created the RTC, the Resolution Trust Corporation. And the RTC, was this big federal organization, but they took over all these failed assets, foreclosed on assets. And they found that a lot of these banks were in oil and gas producing states. and they found themselves with all these oil and gas at these conveyances. So they approached this company called Ebco, EBCO, and they were actually equipment brokers. That's what the EB store, like oil field salvage equipment brokers. And they, the federal government approached them and they said, "Hey, we got these conveyances. You think you can sell those in an auction?" And they said, "Cha-ching, cha-ching. Yeah, sure we can." And so they did, but these were essentially auctioneers, no oil and gas experience.
Yeah.
They were, Bill, my boss and mentor, and his partners that are still active in the industry were, essentially maxing out their credit cards at these live Ebco auctions. Just like no due diligence. They drive out to the field to see what the actual well was producing. Give the pumper a case of beer and get all the information. And go buy the deal. A $10,000 deal that was worth $100,000, or things like that.
It's the Wild Wild West.
Yeah, definitely. And then my version of the history. I'm sure other people have a different version, but Ebco Clearinghouse kind of came and ran Ebco out of business. Ken Olive and Ron Barnes and all those guys were like, we're real oil and gas guys. We're landmen. We're engineers. Integrity, customer service. We know how to run businesses. So they kind of ran them out of business. And then we started, in 1999. They started in 1993. And we were doing it all online. So it was, again, like, Chuck wasn't is Gen X, not a boomer, but I was selling.
Thank you.
I was selling, our service. We can go in and, through a competitive, structured process, maximize value for your asset, your oil and gas assets, and we'll reach more people. You don't have to be at the event. You can do your due diligence online. It's all there. It's a level playing field. But I was selling to people that were my father's age. And they were like, "That's not how we do it, son. The stores, you can see yourself out,
Yeah.
So it was an uphill battle, but we kind of grinded away. But really, in our DNA was,
How
it
long was
done.
it? How long was it like that? That it can't be done.
I would say, 7, 8, 10 years. It felt like from I started till maybe 2010, we kind of took over market share just kind of by begging and pleading and grinding away. But it was always kind of that's not how we do it, or things like that. And then, over time, the decision makers at the E&P companies, the private equity sponsors, or just the owners had Amazon accounts and online banking and everything else.
Yeah.
And it made perfect sense to the people that kind of grew up in that era.
So one of the things I kind of saw from that, let's call it perfect storm, is you had brokers starting, investment banks starting, the online selling. And then you actually had private equity starting then too.
Yep.
You had natural gas partners that started up, NCAP had started up, Quantum had raised their first fund. And what happened is somehow a manager at, let's just pick on Exxon because they're the big guy, sold his buddy a property for $40 million. And he worked it for 2 years, sold it for $200 million, and got like a Lamborghini. And the guy at Exxon got pissed, like this. And so I think you had all those forces come together where Exxon on down said, you have to sell something at an auction. We can't just sell to buddies anymore.
And it's really not just an auction, but just broad market exposure.
It
has to be fully exposed to the market, competition from all sources. And that's really kind of how we, made a lot of traction with the Chevrons and Exxons and BPs and, Marathons of the world because, it checked all those boxes for those guys. They had lots of assets to sell. They were under scrutiny from situations like that. To make it everything on the up and up, no funny business, no selling it to your college roommate type stuff, and then going and start getting PE money and starting a business. So it was broadly marketed, level playing field. Everybody's on the has the same opportunity to buy it if they qualify, if they're an operator in good standing, if they have the funds. So we verify all the funds, we verify they're an operator in good standing, bonding requirements, all those things.
So the call it 10 years, the struggle of building this.
Yeah.
Did you develop a sales pitch that you figured out finally worked? Did old people just retire at these companies and younger people that use Google and Amazon decide, hey, this makes sense? All of the above? Or was there an aha moment? Was it gradual?
I guess I would say it's kind of like scoreboard, point to the scoreboard. So there became a situation where, among people doing it, it was like we built a track record. We had, success stories with companies that were having repeat, consistent success, exceeding their expectations. And then with competitors, it kind of got to a point where there's a live auction and there's an online auction. And when it got to a point that it was, most of the transactions were occurring on our platform, it kind of switched really quick. But up until then, it was, we had a good sales pitch. We had, thought we checked all our boxes. But then it was like, oh, I'm good buddies with this. I'll play golf with this guy over here. So, sorry, Chris, but maybe next time. But we just kept grinding away and kind of, never say die attitude, and just probably, really at the time, and when I started with EnergyNet, I was just too dumb and poor to realize it wasn't going to work. I just figured I need the money, and I'm just gonna figure this out. Maybe they just don't like me. Maybe I can change my son.
Yeah.
So I've been listening to Mark Zuckerberg on Joe Rogan's podcast.
Oh yeah.
And I just got done with it. And one of the things he said that I found really interesting was, because Rogan basically asked the question, hey, when you started Facebook, did you know you were going to take over the whole world? And he said, well, I started it for one college. I thought I might do another college or two, but literally when I launched the website, I went out to eat pizza with some buddies, and we were talking about, it's so obvious somebody's going to do this for the world. It's not just going to be a college thing. He goes, no idea it would be us. We're sitting there going, Google, Apple, Microsoft have all these resources to do. And so his point was, sometimes something's just so obvious to us that we think everybody else is going to do it. And we look up 10 years later and nobody else did.
Right.
It almost sounds like that was.
And there's really no other entrance in the space, right?
They come and go. There are, and they do similar things, but they've come and go. And, it's a really hard business to start, because it does become, am I going to go to the platform that has, 45,000 users, or am I going to go to the platform that just started out and is stubbing their toe and figuring things out on, processes and procedures? So it's kind of a two-sided marketplace, and it's hard. The marketplace problem is that you either have to get inventory to sell or you have to get buyers. So there's stories on two-sided marketplaces, like when DoorDash started, I believe in San Francisco, usually start similar. Mark Zuckerberg started at Harvard, went out to another school. DoorDash started in San Francisco, or kind of that Silicon Valley area, but they didn't have any restaurants. So they would actually go, had a team of people go and get menus, scan the menus, and then you'd order, I'd order Buffalo Wild Wings. And they weren't part of the network. You would just order it, and they're like, all right, I will go order it now from them and go pick it up. Yeah. And they would go, the DoorDash people would actually go pick it up. So there's a conundrum. If we starting a business like ours, you either
creating a marketplace is hard because you need buyers and sellers and need things to sell.
You have to get them at the same time.
Exactly.
If you get a whole bunch of buyers, but you don't have any inventory, then they fade away. If you have sellers, but you don't have any buyers, they have poor results. So it's hard to get going. The idea that was there. So John Lahr is our chief technology officer. He was employee number one at EnergyNet. Bill Britton hired him first. He's a genius, brainiac, created the platform itself. But he was so frustrating just in the early days. He's like, Chris, this is the idea. This is how it's going to work. I was like, you don't understand what the people are telling me out there. They're telling me it's not going to work. And he's like, it'll work. But just the IT kind of
just being early. That's all it is, man.
Actually, in reality, we probably were.
But I think it worked out. So let's dive into, NAPE has traditionally been, marketed as the place where deals happen. Yep. I think over the last few years, I know you've probably been for 20 years. I've probably been for the last, 7 or 8. Is there really still a market for that? I think the question always is, from everybody that I talk to and every time that I go, is, do deals actually happen at NAPE, or do they happen at the Hilton of the Americas bar or the Four Seasons bar? And is it just a reason to get away from, the wife and the kids for the weekend because all your friends essentially just descend upon Houston and you just get to kind of hang out? The thesis there is, you've got buyers, you've got sellers, but it is very much an old school kind of hey, here's kind of our prospect. And maybe it is kind of earlier in the journey to where it's not necessarily, because I don't think you guys are necessarily listing prospects, are you?
We're mostly assets. Producing assets, non-producing assets, but it's not drilling. So it's not drilling deals.
Yeah, so I guess it is kind of maybe apples and oranges then. I don't know. I'm just kind of curious, your take as to where that kind of plays, because we've seen. I'm just going to say, we've just seen declining attendance and declining engagement with NAPE over the past couple of years.
And this will be this winter NAPE will be the first year in 20 years that we haven't had a big booth and exhibition and whatnot exhibit. Over time it's changed. I think there's always there needs to be a place where we can all congregate, like the entire upstream oil and gas.
It's
North
fun.
America.
Don't get me wrong.
It's
I look
fun.
forward to it.
It's fun. I mean, I think it evolved over the years. And for us, we're kind of taking a seat back. I think with at some point there were actual conventional prospects that were for sale, and people would walk up, either rich companies, rich people. Like I'll take a 15% of that deal. And it was kind of a cool way to do it. But with private equity, I mean, private equity guys aren't walking up to somebody's booth and making a deal with them. It's a little bit more.
Did you guys ever go to NAPE, or was it more just like on the speaking circuit?
So what we found, this was kind of funny, is we would get a booth at NAPE, and I would see Chris over at his booth, and I need to go talk to Chris, but somebody's got to man our booth. And then the person that has the offshore prospect off South Africa that you can't even license the prospect, would come into your booth and not leave.
Right.
Yeah.
And it's like, no, I need to go talk to Chris. So
it's like almost like you need like a bouncer with like a
with a rope.
The rope. Like, yeah, you got a good prospect. Come on.
My team would always, just be doing it so long, and that would exactly happen. And like I just kind of wouldn't stand for it. Like I was just like, I'm talking to somebody and I would just like walk away.
So what was funny is we morphed to not getting a booth, but we'd show up and we'd walk around because it's in effect, it's a cocktail party. And I used to do almost the same thing as I just wouldn't stop walking.
Right.
Because you could talk to people and they could kind of walk with you, but just don't stop. Because the second your feet stopped, you were trapped.
No, I think NAPE and the AAPL and all that goes into it has a lot of value. I don't know if it's where deals happen. I think the conversations there lead to deals happen, lead to relationships and trust built and all those things. So
yeah, I've always had a good time.
Yeah.
So in the building of EnergyNet, kind of two questions on it. One, you talked about struggle for 10 years. Did it wind up having a traditional S curve adoption? Okay, that's
very early adopters, laggards, all that. Yeah, very much so.
Explosion. Okay, so that's interesting to me. And give me a story from that we haven't heard that will be surprising to people. Give me your classic entrepreneur. Something happened, whatever it is. I'm putting you on the spot.
No, I mean for us, and maybe not a completely new story, but basically is. But we, in our early days, we Chevron and Texaco merged, and then they had like a 2-year freeze period on that merger, and then we went in and competed to sell and make the mineral bros salivate. But we competed and won a divestment mandate to sell 130,000 net mineral acres in 33 different states that Chevron and Texaco now owned. But instead of doing it as one package where, nowadays Shisio or Blackstone Minerals or Kimball or somebody would buy, just like, all right, I'll take that. Chevron, to understand what they had before they sold it and to make sure their geologists blessed it and, operations blessed it and everything, we sold it county by county and sometimes tract by tract. So it was 2,000 transactions. So winning that divestment mandate put us on the map because everybody was like, what's Chevron selling? They got stuff in Martin County, or they got stuff in East Texas, they got stuff in Wyoming. And it was minerals, non-producing minerals for the most part. So people were buying it up, competing for it. It was working. It was like moths to the flame for our platform because people sign up, have a username and password, and then they're hooked for the next deal. And it builds on itself. This is like 2003 through 2005.
Okay.
But in selling it kind of parcel by parcel, I think, we 2x or 3x their estimated value from what they would have received. And then with the success of that, even the people like our champions at Chevron at the time, mostly retired now, but were, producing properties have to be sold a different avenue. And we're like, oh, come on, man, let us sell these non-ops, let us sell these royalties, these overrides. So they'd give us a chance, and we executed on that. And then it was, operated properties, you can't do operated properties in an online auction format. And we're like, give us a shot on something small, and we executed on that. And then, before long, we exited Chevron out of Wyoming, sold it to Hillcorp for, I want to say $100 million. We did a big $100 million deal in the Velma water flood in central Oklahoma. Now we've done, multiple $100 million individual transactions for them, but it was like a graduation level. And every step along the way, it was like, you can't do that.
What's the biggest deal you guys done so far?
About $225 million.
Jeez, what kind of deal was it?
This was all of a non-op transaction.
Okay.
Yep.
So I always joke, my mom is the only person that listens to my podcast. So, and dear sweet mom is one, very naive, two, knows nothing about energy. For mom, walk through what the process is like.
Sure.
It's mom, oil and gas company, wants to sell something and says, hey, Chris, what do I do?
Sure. And what's interesting about our platform is that we really have a reason to call on or to interact with any person that owns oil and gas assets, whether that's ExxonMobil or BP or Granny Yates. I don't know what you call your mom.
Mimi
Yates. But we have conversations like this with mineral owners. They inherited things all the time. So we call them, they call us. A lot of times it's for those types of sellers. It's a referral from their bank or from their lawyer or from someone else that's more engaged in the industry. We don't necessarily target those customers, but we sell for them all the time. And so we talk to them and we say, what we're going to do for your asset is that we're going to create a comprehensive data room with production, with cash flows, with mapping, with how you own it, how you're going to convey it, if there's upside, all those things. And then we're going to, you're going to be able to review the data room, make sure everything is accurately portrayed. And then, we're going to expose that property and market it to a large universe of prospective buyers. We're going to, we're going to personally contact the area operators surrounding it. We're going to personally contact the, the buyers that have bought similar properties in the past. One of the cool things about our platform is from like an administrative level, Big Brother's watching. Like, so when you're logged on, we can see, and there's a record of everything you've ever looked at from instance you had a account. So we know what you bought, what you paid, how much money you have as a bid allowance. So we can target the next asset based on previous transactions, kind of like a recommender engine type situation. But with that, so it's about a 21-day to say 35-day sale process where we give everybody time to evaluate it, make sure, everything looks right, get management approval, determine a value. And then there's either a bid window through a transparent bid auction, or it's a sealed bid. So both processes work exactly the same. Either you see other people's bids or you don't.
What's the sealed bid?
So the sealed bid, it's very much so if today's September 9th, so if Mimi Yates had the property, it would take us about 7 to 10 days to build the data room. Mimi Yates approves it. I hope she's listening. And then roughly about a month later, so say October 9th or 10, bids would be due. So if it's an auction, then there's a 7-day window you can bid, and if it's a sealed bid, it's just at 4 p.m. on October 9th.
So there's no actually auction component to the sealed bid. It's just, hey, I'm just going to submit. It's more like a blind auction, right?
Well, it's a form of auction, but it's just you don't see what you're not bidding. You have your best offer.
It's not the eBay model.
Not the eBay model.
Which way is preferred give me some data on what?
Yeah, certainly. So really, it kind of comes down to value, or in our estimation. So currently, we do about 2,000 or so transactions a year annually through the transparent bid auction format. And those are typically sub $10 million in value.
Okay.
We sold one for QEP Resources back when they were kind of monetizing things. And in the auction process, it sold for $35 million. And two companies, ran it up. The beauty of the auction format is that everything is defined. Imagine if in the oil and gas industry, everybody agreed on a PSA. There was, and that's essentially what we've created for this structure, that everybody agrees on the same PSA. The seller's outgoing conveyance is the controlling document of the sale. So when you bid, when the process really boils everything down to the price. So everything is predetermined except the price. The effective date is known, environmental liabilities, my watch, your watch, all those things are done. Taxes are done. So when the auction ends and the seller's minimum reserve price has been met or exceeded, we invoice the buyer. They have 2 business days to pay our escrow account, and then we act as closing agent and close the deal. So that's how the auction works. But there's a trigger, a sale trigger price that you as the seller have the ability to set a minimum reserve price. The buyers don't know what that minimum reserve price is. They just know there is one, or there's not one, or it's been exceeded. But once it's been exceeded and the auction ends, it's a done deal. We invoice the buyer. They have 2 business days to pay. We file that there's no negotiation from that point on. If it doesn't meet the minimum reserve, then we step in and say, Mimi Yates wanted $1 million for that asset. It only got up to $850,000. Mimi, can we go back to the top 1, top 2, top 3 bidders and see if we can get a deal done? She said, yeah, you can do that. So we go back and get the best offers we can. Sometimes we exceed it. Sometimes we get closer to the minimum reserve price, and then we close it at the same fashion. The sealed bid, similar to a typical energy investment bank, bids are due at a certain time. They submit an offer letter with maybe a markup of a PSA or term sheet or red lines, things like that, and then it's a negotiation back and forth. So we present all that to the seller. They huddle up and say, all right, let's go back to the top 3 or 4, have a pencil sharpening exercise to see if they can increase their offer potentially, or just how fast can you close, what needs to happen before you close. So it's a little bit, the sealed bid provides a little bit more flexibility for the seller and for the buyers, really, just to conduct additional.
And those are the larger deals usually?
Typically.
Yeah. Where there's a lot of kind of just, I guess, their own interpretation of the value, particularly say like PUDs.
Mainly. And that's another reason. So the auction works really well for PDP assets, royalty assets, kind of straightforward assets where, if everybody can agree that the PDP PV10 is, $5 million, then it's just who's going to bid, 5.3 or 5.4 or 5.5, kind of around that. But if it's really subjective, it's better to do a sealed bid approach because you want to capture the outlier bidders. So, this company may see a lot more value in the upside or what they can do with it than somebody else. So you want to, kind of, you're hoping for, and it is really a bell curve. And we see that again and again where, there's, we did one deal and it was a $80 million deal. We had, I think, 25 offers, and 15 of the offers were between 35 million and 45 million, but 3 were, $75 to $80 million. So it's like the consensus is here, but the consensus doesn't win the deal.
Yeah.
I mean, you can say that asset is worth X, but it's like if I had a jar of pennies here, a jar of coins, and you play the game, how much is in there? Like it's one thing to guess how many coins are in there, but whoever just pays the most and wins in a competitive sale process.
Yeah. Well, the thing I think that's the best pitch for you guys is at Kane, when we would go out and sell a property, for the longest time, we'd say, okay, everybody, write down who's going to buy it and how much somebody's going to pay, put it in a sealed envelope, and we'd open it at the end of the deal. And we were never right.
Right.
I mean, the only time we got right was James Broach said that Lynn would wind up buying Stallion. He was way off on the number. And we were like, no way. They just bought Black Sands from us. There's no way. They don't have the capability of doing that. That's the
I remember that deal. Paul King at Stallion.
And George Sanfilippo. Yeah. But the key was, and that's why we were always like, you got to make sure everybody sees it because you just don't know. You don't know what happens in the boardroom 2 weeks before the information goes out, and so everybody needs to see it.
Yeah. I mean, there's different schools of thought, and like we are ingrained and, in the competitive sale process, consistently deliver the best outcome. I mean, we occasionally do private sales, targeted sales. But when sellers ask us to do that, it's kind of like, all right, handcuff my feet to my hands, and now let me try to do this deal for you. I mean, we want to just...
trust me, I sat down with sellers all the time. Man, if you give me a little exclusive, I can work it harder, get you a higher number. I'd buy the drinks all the time, and it was never true. Okay.
Right.
Stop. I want to put something in front of you that you're gonna have to say no to. Yeah.
But there is a spectrum, and it's where you sit on the spectrum of a buyer or a seller. Like a buyer wants to get the best deal possible, and that usually means submitting an unsolicited offer, and the seller accepts that for whatever reason. And that's what a lot of companies do. That's the mineral ground game. Companies do that all the time, lobbying in offers on adjacent fields and whatnot. But the reason that they're submitting an unsolicited offer to you is probably because they know something you don't, or they think they can. I mean, it's not because they want to pay you the most. But then from a seller's perspective, you want to get the most value. You want to see, if you can get Oxy to bid, or if you can get Diamondback to bid, or if you can get a private equity company that just got new money, or they're running out, their commitment's running out, you want them to bid, and just see, it gives you options as the seller. So I always joke, on the unsolicited offers, if I can go into a bar, a nightclub, and I'm the only guy there, and it's just filled with beautiful women. Yeah, I love that, but that's not how the world works.
I could screw that up. Don't worry about that.
I can screw it up too.
Been there, done that. I can mess that up with the best of them.
I mean, has there ever been that temptation of like, hey, we have access to the best deals, that like we start accumulating like our own assets? Maybe it starts off in the early days of like, we're just trying to get this thing going. We're just going to take some overrides, and then that kind of balloons, and you're like, oh shit, like we've got a pretty good thing going here.
It was definitely discussed, and to Bill Britton's credit and the leaders at the time, we just said we're never going to compete with our buyers or our sellers. We're never going to be perceived that way. So we have never bought any deal that's been listed or even brought to us. And sometimes we see. It is like part of our pitch, and like I have friends, just that, Atherton, hook me up on a deal that is coming to market, and sell it to me instead. Kind of the same situation, but
I've tried that with you. Yeah.
but even in my, Chuck was asking like what our pitch is, but our pitch is, usually the first words out of my mouth is that we're gonna create a competitive process. We're gonna, put this asset in its best light. We're gonna get a lot of people to bid on it, and exposure and competition, and we're gonna run through walls to make sure the right people are looking at it and the right people are bidding the most. But then after I say that, they can't say, well, now I want half the value I really wanted. So there's not many, I guess, just in our conversations with potential sellers, there's not many deals to be had, I guess, that are steals.
Yeah.
So do this. 2 or 3 trends today in the market. What are you seeing out there, kind of in deal land? I want to talk that for just a second, sure. And I'm going to go ahead and say this just so you'll have some time to think while you're talking. That is, then I'm going to ask you, what are 2 or 3 trends we're going to see over the next 5 years?
Okay.
So what's going on today, and then we'll talk tomorrow.
It's interesting, and you experienced this in private equity world, that, there was a time where it was a traffic jam of, kind of 2018, 2019, 2020, where private equity companies were essentially built to sell. You're building a product to sell, hopefully to a publicly traded company. But there was a traffic jam where the publics weren't buying. Like it was salad days when they were, but when they stopped, people were like, do I have to drill my returns now? Like what's is my 3 to 5 year exit going to be 8 to 10 years? So that occurred, and we went through that and got through that. But now, I think a lot of the large publicly traded companies, or just publicly traded companies in general, E&P companies, are seriously looking at their inventory and seeing how much they have left, and that trend's starting to begin again. So we're seeing that in terms of publicly traded companies significantly paying for upside, for acreage, where maybe they weren't a while ago. So that's kind of one trend that we're seeing, and we think that will continue, where the Oventives and the pioneers of the world are going to be on the hunt. More macro to our world is just that you need to get big quick, and we see companies like Silverbow, companies like Earthstone doing that. Continental's on a run, Devon's on a run. I think we'll continue to see bigger companies get even bigger. I would say that another trend that we see, that we interact, because there's acreage deals that are more exploratory development, shale deals. There's PDP deals. There's a different buyer segment for just heavy PDP deals. A typical publicly traded company does not want, for the most part, to buy just a PDP deal. That doesn't help them. They need to buy inventory that they can use their expertise to exploit and extract value from. There are buyers that have different investment parameters. I consider the Diamondbacks and the Pioneers of the world, the Game of Thrones. And then there's the Merit Energies and Scout Energy and Foundation that are more of Law and Order, CSI. It's very formulaic, where, we're going to get this asset, we're going to give it some TLC, we're going to do some workovers, we're going to reduce OPEX, we're going to increase production, but not, we're not going to turn, zero into 10,000, 30,000 barrels over a couple of years. They're going to incrementally grow that. So there's the PDP side of the operations, development, drilling, but then also over here there's the royalty side and the non-operated working side. So the royalty business, and you guys know with Carbon Secchi and Kimball and all these mineral and royalty companies, a very dynamic market. It's a very large market. It's very fragmented. But the royalty and mineral market, I mean, you have to, each there are a lot of small deals, and it's like I equate it to, if you can do a royalty and mineral deals, you usually have to make a deal with the owner of the asset, and it's like trying to cut your front lawn with a pair of scissors. I mean, you have to do like one deal at a time, because you have to have an agreement. But then the non-op side, I think partly because the mineral and royalty side has gotten so institutionalized and so developed, and it used to be on the minerals and royalty side that it was I'll pay you 90 months cash flow for that or 60 months cash flow for that. But now it's basically operating teams that are looking at the development plan. So they're treating all these assets like they're, like they operate them and how they would value them. Because that's gotten so mature and institutionalized finance, it's kind of spread over into the non-operated working interest side. So that's kind of an interesting dynamic as of late, just for the past 2 or 3 years, where there's a huge market for buying outside operated non-op AFEs. So a company like Devon, for example, all of their vast holdings and operations and acreage all over the place, they get outside operated AFEs coming in like the mail. It never stops. I mean, there's 20, 40, 50 a week. And they have to decide, are they going to participate or not? So there's a vast market right now of people saying, I'll step in your shoes. You don't want to drill that well in Wyoming in the Powder River Basin, or you don't want to drill this well, like I'll step in your shoes. I'll pay you a premium on top of what the AFE costs to do that.
That's been a fascinating development. Wellbore Wednesdays, right? Yeah. Because your Oxy, and it's like you have this amount of budget. Well, of course you're going to spend the budget on what you operate.
Right.
The stuff you don't want to operate, even if it's operated by Shell or EOG, some other good operator, you don't want to do it. So they're literally giving those away.
I mean, and it's developed into a market. We're actually starting like this. I'm saying it out loud, but we have a portal on EnergyNet that's specifically for that.
Oh, cool.
So just to create more liquidity for those non-op AFEs, some companies like Concho with Wellbore Wednesdays, it's very streamlined, but still a lot of time and effort. You're going back and forth on all these negotiations. So we're going to work to do a lot of heavy lifting for maybe some of the companies that don't have a process in place, or it's kind of your hair's on fire. You have to consent by, today at 5 o'clock to get the deal done, or it just goes away. So we have our EnergyNet non-op AFE divestment portal that's live, and we're doing deals. I think we've done 100 or so transactions thus far, but it's kind of in beta right now. It's just really launching. But when I first saw that happening, a couple of years ago, I was, who's going to buy, like on the other end, like the people that are doing that are buying wellbore only, non-operated working interest, but then they have a portfolio of 100 non-op, wellbore. There's no upside to it anymore. I mean, it's just a cash flow stream for cash flow. But now, we did a transaction October of last year for $154 million. That was all 36 wells in the Bakken, multiple operators, but wellbore only, and lots of buyers for it. Dozen or so, 14 different bidders, and it was sold to Northern Oil and Gas. But there's an end case for that. And now with Northern being Northern's always been a non-op publicly traded company, but now you have the Gray Rock team, now they're publicly traded non-op. Risa Energy is buying these and securitizing them on the other end. So it's very becoming a very dynamic market.
That's it. Okay. So now we're doing this podcast in, let's say, 4 years, and we're talking about the big trends. What are those things we're talking about that we're going to be talking about in 3 or 4 years?
Where's the puck going?
Yeah, exactly.
In that, I think there is some of it has to do with these asset transactions, but I think there's a push towards making oil and gas as an investment, as an investment class into more of a security, like being able to, like right now you have to, you buy a $200,000 asset, you have the conveyance, it's filed in the county, you own it, you can sell it. But it is an asset class like real estate, stocks, bonds, mutual funds, ETFs, things like that. I wouldn't be surprised if in 5 years somebody kind of cracks the code in terms of how you could turn that into, more of a, your Edwards Jones broker calls you and says, you want to buy some, Salesforce.com stock today, or do you want to buy like $100,000 of West Texas Minerals? And it's just very, very similar to that. I could see that, and that opens up, a lot of different things just in capital to the market, things like that.
Yeah. What about any chance, because this makes so much sense, which is why it won't happen, all title in America done on blockchain? No more going to the courthouse trying to figure out.
Yeah,
where
a lot of people are
Joe
trying
Bob
to figure that out
lives.
too.
Yeah.
That's yeah.
We killed a lot of brain cells about that a few years ago. I don't know if you know that. Like a lot of brain cells, probably like 8 or 9 months deep into it. I'm just going to tell people how to do it, because if somebody does it, it's a massive undertaking. The way you do it is you literally you take the Uber model and you use the gig economy and you use existing landmen to go out there and you use bounties, right? Use bounties, bounties for a certain amount of data. They go out there with the apps, be able to go out and structure all of this information, put it all on the blockchain. Once it's on there, it's on there. Because if you, as a private company, imagine you try to go out there and go to every single fucking courthouse and structure this entire thing and do all the title yourself, it'll never fucking work.
Right.
But if you use the gig economy,
I agree
it will
with that.
work.
And there are companies, especially in the Permian Basin, that I won't name names, but I think I know of like 3 or 4 that have just been buying royalties and minerals in the Permian Basin for so long that they themselves basically have title run, from the beginning of time till today on just about every county, just because they've been doing it for 30 or 40 years.
I think the biggest barrier there is the brokers.
Yep.
Yeah. Because you're essentially,
but
they're gone.
There was a company, I don't know if they, it's a company called Run Title, but I remember that the way they explained it to me, it was like, if you have the book Moby Dick, it would be like, I hand out copies to all 3 of us and we just write the whole book again in another sheet of paper. And then when something else happens, we just add another little paragraph.
Yeah.
But that's how you run. I mean, that's how titles run.
That's blockchain. Yeah. It's blockchain and its title. Yeah.
Yeah. But
it's just crazy to think that you run title every single time there's a new transaction. It's just so much, it's so redundant and it's so wasteful.
I haven't spent enough time thinking about the economics for the county. And when you think economics of the county, you got to think social good of jobs, of people working in the county, in the title offices too. Because it would make sense to me if I'm the county judge of someplace. It's like, man, we're gonna in effect give all our title information to blockchain, and that way we never have to mess with it again. Some company that would do it, in effect outsource it, and the company might even pay you.
For the opportunity,
to do that. But I guess you wind up putting people out of work in the county.
The question is like, would that blockchain be owned by a company, or would that be something that would be totally just open source and utilized by everybody? And I don't know what the right answer is, but I think that answer would dictate whether you get mass adoption or not.
Right.
Yeah.
Right. Yeah. I mean,
closed systems have a tendency to look really good on financial forecasts, but never seem to work out that well.
Right. But in the kind of gig economy, what you're talking about with each person, adding their own piece to it, and it being kind of a collective, open source that they can all benefit from. That makes a lot of sense if you could convince them all to do it.
I think it'd work.
So we've gone macro, what's going on now? We've gone macro in a few years. 5 years from now, what's EnergyNet doing? So what do you look like?
We've had a kind of with the S curve, we've had a continued growth. So our areas of focus, we spent the last couple of minutes talking about kind of our auction business. That was our primary business, and it kind of provided a foundation. With that, we've created EnergyNet Indigo, which is our version of energy investment bank or boutique advisory firm. So we've done, in the past 5 years, maybe 150, 160 deals between, say, $15 million in value and $225 million in value. More traditional, here's a 6-week data room. Here's a executive presentation, technical presentation. So we have Keith Reese, who leads our technical team, Jonathan Calkin, Riley Blyton, Cameron Cooper, and Keta Sinha that are running our technical team and building the upside story and the narrative. So we're winning and closing on higher value deals. So that's one area that we're focused. And it kind of, we're not an investment bank, and never will be, but it marries kind of the transaction experience, all this knowledge of all the sawdust that's created from all these transactions, who bid, who didn't bid, who's going to bid on the next one. What did this guy bid? Like all that kind of user data, buyer data, and then data on the assets. It marries all that transaction data and user data with, the horsepower of a really strong technical team that can explain the upside, explain the narrative, the story. When I throw you the keys, here's how you're going to, drill these, 4 different benches and in what order and how you're going to unlock value and what the value is of doing that. And then that's why you pay the highest price for it.
That's kind of a no-brainer, because think about like all the data that you guys have is such a major asset from all the experience, which gives you a significant amount of horsepower to be able to pull off those deals. I just think if I was in somebody's shoes and I was looking at that, comparing it to, say, a traditional investment bank, I mean, you guys have been doing this for 20 years. You have so much information about how to be successful in this space.
It's like within, like, I mean, just the investment bank model, it works. There are great banks out there and great people that work at those, and very intelligent, skilled experts in that realm. But there are times where it's like, this particular group hasn't done a deal in the Eagleford or the gassy part of the Austin Chalk or whatever in a year or 2 years, where we may have done 50 transactions. They may not have all been $1 billion, transactions, but they were sizable, and we talked to buyers, interacted with them, and found pain points or reasons they were buying or things like that. So I think that gives us an advantage, and just we're continuing to get better and better. It's kind of like the graduation story with Chevron, where just applying that to more broad E&P companies and
well,
users.
do you marry? I'm thinking about this. Do you marry the two of them? Meaning, my frustration as a seller through the years was the allocation schedule, where you look down and there's zero for like 25% of the properties. And you go back to the buyer and you're like, well, we'll keep this, and it blows up the whole deal.
Right.
So you're always just like, screw it. That was the high bid. Take it and let's move on. I mean, is there a world where me as the seller walks in and you go, hey, Indigo's going to do this. We're going to run this through EnergyNet?
Yeah, we do that, and it's not. I mean, it's they're kind of side by side. So we'll say, I guess a lot of times if it's a geographically scattered package, we may have like the $90 million portion over here, and then there may be a $10 million portion that we run as 25 auction transactions just to maximize value for each component piece. We like for us at least, we think that the sum of the parts is typically greater than the whole, and if we can allow the seller to do that, and we can say, here's 25 20 $500,000 individual deals, and then here's the $90 million package over here, and we can run.
Here's my operated by others.
Others.
Here's my wellbore straight. Oh, okay, that's cool.
And it just allows some buyers don't have the pocketbook to do a $100 million deal. Some buyers want to buy the assets in their backyard or that they've been having an eye on for a while, but they don't have the capability, or they don't want to take on all of this stuff. So. We do it both ways. So sometimes it'll be, we'll break it up. We'll say this is the best way to maximize value and to get everything sold. Sometimes it's the other way, and the seller just says, get rid of it. I want it all gone. But then we talk to the buyer and we say, hey, all right, this deal and this deal and this deal after you buy it could potentially be worth, so if you buy it at X, you could potentially come back to the market in a year or 6 months and sell these assets for these values, because we have all that data at our fingertips.
Is there ever like I don't know if you guys have thought about this or if it's not possible. I'm just kind of shooting from the hip here. But imagine as a buyer comes in and is looking for, whatever asset, say it's, $1 million, right? Have you guys thought about like baking in kind of like financing options? I'm thinking like from the personal finance side, right? If you want to go get like a personal loan, you put in all of your information, you get spicked back a bunch of quotes, right? And that can be based on, yeah.
No, I think it's a great idea. We haven't cracked the code on how to do that. We're trying to think about it. Right now, a lot of individual buyers will use their personal wealth, or it's called private wealth accounts. So they'll have if they have a couple
borrow against public stock, basically.
Borrow against yes. So they have
Those
they have an account.
Those are cheap loans.
They are, and they have. So what they'll do is just they have an account with Amegy or JP Morgan or whoever is their private wealth manager, and they maybe have $3 million in stock or whatever, but they can get a loan based off that. But we are trying to move towards kind of a staple financing, microfinancing that's just like, here are a term sheet, and if you would like to use that, you can. But we haven't cracked the code yet.
I just think it'd be interesting. I mean, imagine if somebody, I'm just thinking about like bootstrapped entrepreneurs that don't come from money, that don't have assets, because I've been that person for 10 years essentially, right? And we went out and bought some wells and just did them off market. Ended up paying cash for those. But yeah, I mean, if you were able to essentially say, especially if you're going out and buying PDP and it's shooting off cash flow, I mean, could you essentially say, hey, I'm going to buy this, and then I'm guaranteed, like, securitize the asset that you're essentially buying, and then have that cash flow come off and pay the note, right?
Yeah, definitely. We're trying to figure that out. So may tap you to help with that.
I think it's a huge opportunity. I'm genius.
And the other area for EnergyNet now, and then so I haven't mentioned it thus far, but we have this user base.
Are we breaking news?
No.
Okay.
No,
all
but
right.
we have this platform user base. 45,000 registered buyers with EnergyNet user IDs and passwords. All these oil and gas transactions that have been done. And then EnergyNet Indigo for the higher value deals, the more complex deals with upside. We have the technical team that showcases that. But we also have the third leg of the company is our government resources business. So EnergyNet, the platform, facilitates the lease sales for Texas University lands, Texas GLO, the Federal Bureau of Land Management. I think we're at 16 or 17 different agencies. So we run their oil and gas lease sales. So it's we augment, it's a legal description. Here's 640 acres. Here's the terms. There's no negotiation because it's done by the state or the federal government. And then we run a competitive process to see who's going to pay the most. But with that, and that's been very successful. So in September of 2018, the salad days of the oil and gas business, we ran the Bureau of Land Management New Mexico lease sale in the state line area of Lee and Eddy. And it sold for, $1 billion in a day. And, people were paying, $90,000, $80,000, $60,000 per acre. 2 sections were going for 1,280 acres. We're going for $100 million.
Yeah. You guys crushed that.
But it was getting all of the Chevrons to compete with the Ameridevs, to compete with the, WPXs at the time and Franklin Mountain and, Matador. And, but it shows that, it can be done. So that was a big win for us, big win for the U.S. federal government, and the companies. The companies have done really. I mean, that's still probably the hottest area in the country, with the success we've had with these government agencies, and they're very difficult to get into. It's bureaucratic. Things start and stop. Lots of rules and regulations involved. But because we've had success, we've said, hey, you got this real estate over here you own. And instead of, running your own process or putting out a feeler, let us run a process for the real estate. So, I believe it was last year? No, or earlier this year. So the western states of the United States, there's a huge swath, I think 43% of the land is federally owned. So the city of Las Vegas, Henderson County, was the county of Las Vegas? I can't remember, but
Henderson's
is a city. I'm blanking too, but the city of Las Vegas is essentially surrounded by
Clark County.
Clark County, Nevada. But it's surrounded.
I had to play like I didn't know that for a while,
like Clark Griswold.
Clark, that's right. Yeah.
But surrounding the city and the county is basically this federal land. It's desert. But as the city has expanded, or Reno or Las Vegas has expanded, that surface acreage becomes valuable for developers. So we ran a competitive sale process for the surface land and had all these homeowners bidding on tracts of land and sold $180 million of real estate.
Oh, wow.
So all these government agencies that we're working for have solar rights, wind rights, lithium, carbon capture type stuff that we're trying to help. They don't necessarily know what it's worth, but they know that they need to run a competitive process to get the most value for it. So we're helping them do that. So that's kind of the tip of the spear for us.
Oh, that's really cool. The university lands, the University of Texas owns 2/3 of it, and A&M.
And Port Texas Tech.
Port Texas, but A&M owns 1/3. What does that tell us? A&M got to choose first. That's like my favorite joke. But
right.
So, Chris, who do you want phone calls from? And of those people you want reaching out to you, how do they reach you? Website. I'm assuming you want anyone that ever wants to buy. You want them registering. Anyone that wants to sell.
Certainly.
Walk us through how people get in touch.
Certainly. I'm pretty accessible. Phone numbers on the web. My cell phone's on the website. Email address is chris@energynet.com. On LinkedIn, on Twitter. And we have our team of professionals at EnergyNet. We're real connected. Everybody's really involved in the industry and a participant kind of in the community of it. I'm involved in the Houston Producers Forum, involved in IPAA. Ethan Howells is involved in the Petroleum Alliance in Oklahoma. But we're involved in all these, SPE, things like that we just try to stay active and involved. So Dina Arias, Cody Felton, Lindsey Ballard. We have offices in Midland, Oklahoma City, Denver, Houston, Dallas, Fort Worth, and Amarillo as well, obviously.
Oh, very cool.
Yeah,
very cool. I actually stopped in at the ranch and tried to eat the steak.
Oh yeah,
last summer.
Oh yeah, I saw that.
It did not end well, but it was a lot of fun to do. Next time you go to the home office in Amarillo, let me go because I want to try again.
Yeah, no, I think the key, because I've had friends, I've never done it, but I've had friends like live stream it. But I think the key is that you video it, but then you don't post anything if you don't actually do it. If you don't,
not me. I announced that I was going to go do it, and of course that didn't end well.
So before we wrap up, I got one cool story. I think I mentioned to you, but I just want to just talk about it on the air. So we had, for our Zero event, we had Marcella Burt come in, and she was one of our panelists on one of the content, and we were sitting down before, and she was like, "I got to tell you, I've been listening to the podcast since day one." She was like, and I heard guys like, David Ramsden-Wood in the early days, and Seth Blackwell, and a bunch of the early like E&P guys that came on and would tell their story. She's like, I was just so inspired. She's like, I got on EnergyNet, made an account, and her husband started just piecing together non-op positions.
Nice.
And now they've got, I think positions in like 40, 50 different wells.
Oh, wow. That's
and
great.
I thought that was a really, really cool success story that, just from hearing the stories of the community and then using, such a powerful platform that you guys have done, and they've built up, essentially a really strong annuity, right?
Yeah, no. Yeah, that's a lot of people do. And that's great. I need to get her name and address and send her some swag.
Yeah, absolutely. Marcel, this is me calling you out. Come on the podcast. I want to know the deep story. But Chris, man, this is absolutely fantastic.
Yeah, no, thanks for having me. I'm really excited. What you guys are doing is fantastic. I like how the energy that you guys are bringing to the industry. It's fantastic. I
just making oil and gas fun again, man.
Yeah, no, definitely. I'm here in my shorts.
Yeah, I love it.
Chris, thanks for coming on. This was cool.
Yeah, thank you, Chuck. Appreciate it. Thank you, Jake.